I'm Helen Nichol, and I'm delighted to be moderating this session. I have over 20 years derivatives experience working in investment banks in several departments, including listed derivatives and OTC. More recently, I've worked on the vendor side at Lombard Risk, leading the collateral product team, and now at VERMEG. The agenda today will cover a variety of topics, but will focus on regulation, UMR Phase 5 and 6 requirements, and innovation around the collateral space. We have a combination of guest speakers, a panel session, and also have some polling questions. So I'd encourage audience participation wherever possible. We also plan to have a few minutes at the end for audience questions, so please send your questions in throughout the session. I'm delighted today to be joined by Chetan Joshi, Liam Huxley, and Asma Belgade Haseen. Chetan Joshi is the founder and CRO of Margin Reform. Chetan also has over 20 years' experience across the margin, collateral, and legal domains, having held a variety of roles at RBS, JP Morgan Chase, Barclays, Bank of America, and Standard Chartered in operations, change management, and front office. Chetan also has previous consultancy experience at Moringa Partners. Liam Huxley is CEO and founder of Cassini Systems. Liam ran investment banking development groups, both in the UK and the US, before co-founding Syncova, which developed the market-leading platform for hedge fund portfolio margin and financing. Liam founded Cassini with a forward-looking concept and providing the buy side with full modelling of all new costs and constraints created by clearing and related regulations to allow more efficient trading and portfolio management. Asma Belgade Haseen is a senior collateral product manager at VERMEG. She has over 10 years' experience in asset and collateral management, having held leading roles at Lixor, Societe Generale, in portfolio management and in a self-founded service provider company. We also have a special guest today in Amy Caruso. Amy is head of collateral initiatives at ISDA, where she is responsible for developing and delivering a transformational strategy for collateral management, including facilitating innovation and compliance whilst driving standardisation and efficiency. Amy will present after the panel session. I thought we would begin today with a brief overview of industry updates. So I'd like to ask Chetan Joshi to provide his perspective on the recent changes. Chetan, over to you.
Thank you, Helen and VERMEG, for inviting us on this webinar. Hi, everyone. For those of you who don't know us, Margin Reform are a boutique challenger, management and IT consultancy. We've been helping firms since 2013 in getting ready for Uncleared Margin Rules, UMR, or SIMM for the purposes of today. I wanted to briefly touch on the title of this webinar. SIMM, which is short for ISDA SIMM, stands for Standard Initial Margin Model. It is an approved internal model and is one of the two IM model methods universally used to calculate daily posting of IM. The other model is a regulatory schedule grid published in the relevant Uncleared Margin Rules by global regulators. Newly in scope counterparties can choose one or a mixture of two models to calculate their IM on their portfolios. Later on, Asma and Liam will go into the detail of these calculations. So let's move on to the industry update. Going back to March 2020, there was a regulatory update from the regulators. So BCBS IOSCO received a joint letter from ISDA and multiple industry bodies seeking a delay to UMR phases 5 and 6. The good news back then was BCBS IOSCO agreed with the recommendations from the industry, and each global regulator then went on to endorse the guidance agreed to amend their final rules to extend phase 5 to September 1, 2021 and phase 6 to September 1, 2022. They also allowed firms the ability to only monitor their group level IM threshold of 50 million. This is a get out of regulatory fine card you should use where applicable. Looking at the numbers, so how many firms have benefited from this delay? The middle visual we created by taking publicly available information from the industry to show you the earlier phases of UMR versus the new ones. Earlier, there were low numbers, but when we get to phase 5, they jump up massively into hundreds of counterparties and thousands of relationships. Phase 5 is estimated to bring in 300 plus counterparties and 3,000 relationships. Phase 6 is estimated to bring in 700 plus counterparties with 5,000 relationships. So large number of counterparties and relationships coming into the later phases of UMR. If we move on to the third visual that we've created, when we go into the future, what can you appreciate? Why we can appreciate why SIMM is flying under the radar due to other regulatory projects and consequences of COVID. Here are a few drivers that have set project management resources and technologies and lawyers working in silos all together. You have a number of UMR exemptions that are due to expire at the end of the month and the beginning of the year. You have SFTR for phase 4 going live. So there's a number of challenges for firms to deal with. And what we wanted to do today was get SIMM back on the radar for you and help you understand the challenges that are around that. As we get close to these go live dates, it's important that clients respond back to their counterparties, they complete their legal paperwork. And if you don't do that, unfortunately, organizations will stop trading with you. So it's really important to understand what you can and can't do and looking to understand the 50 million threshold, which we'll talk about later on. I wanted to go to the first poll. So this first poll talks about what IM phase is your firm expected to fall into. Option 1 is phase 5, option 2, phase 6, option 3 already live from phase 1 to 4, and then option 4 is don't know. So we'll just give it a couple of seconds to get the votes coming in. Okay, so a handful of people have voted here, so a mixture of phases 5 and 6, which is good, so we can go through some of the key pain points for phases 5 and 6. So thank you for those of you who voted. We'll have a few more polls coming up, so we can look to get some more votes coming in. So I just wanted to go back further to 2015, where we were helping a phase 1 bank, Standard Chartered, go live with UMR. Back then, we didn't have the luxury to test and onboard slowly for 12 to 24 months before go live. We all bundled over the regulatory line and had disputes and settlement fails. Plus, we built most of the technology ourselves. Since then, things have changed dramatically and improved. You can now buy components of the technology off the shelf, which saves you time, money, and gives you a peace of mind. So now let's look at the client reactions. At Margin Reform, we've been speaking to clients and prospects around the delays and industry updates. So the first reaction we've had is around pre-trade analytics. So pre-trade analytics has been a key area for organizations to really manage their thresholds. So with UMR, you have two main thresholds, which is around the average aggregate notional amount, and then the group 50 million. So we've seen many organizations now get into investing into the right technology around pre-trade analytics, working out what trade needs to go on to keep the trade and the risk from reducing the IM numbers. So that's been a big key growth area we've seen with our clients. The second area, which I'm not going to go into too much detail because I know Liam and Asma will talk about this, is the IM threshold monitoring. So IM threshold monitoring is a saving grace for many firms, as you only need to watch and monitor after signing a side letter with your client or your counterparty. And this is where you agree within the threshold, you create a sub-threshold, and that could be 20 million, it could be 25 million. So you allow the exposures to build up to that point. With IM threshold monitoring, it now creates a new process to set up and to keep ongoing as part of your compliance journey. The next area we've seen a lot of interest in is around insourcing versus outsourcing. And as I mentioned, when we were building out the UMR program back in 2015, we had to build everything from scratch. Now there's many organizations looking at outsourcing a lot of the components. So the third visual here, which will come up, will show you what we're seeing around the responses, where many firms are now looking to outsource a lot of this. So they're not looking to buy, they're not looking to build, they're looking to buy a lot of these components and get support around that. The next area, the next visual is around optimization, which is again, many firms are looking into optimization, but also looking at IM model governance. So these two areas have obviously picked up a lot of traction recently from clients. The IM model governance surrounds the rule around making sure you've got the right people running the IM models and having clear roles and responsibilities. And the optimization, which again, Liam will go into a bit more detail, is around your bilateral trades and your cleared trades, where there's now opportunities where you can look to clear as much as possible, and what you're left with the bilateral is looking to optimize that for the benefit for your capital, your balance sheet, and your funding. So these were the key reactions that we've seen in the last 7 months. And what we're looking to do as part of our research at Margin Reform is also to run an industry survey, which we've launched this month. So what we're showing here is a link to our survey, which is running until the end of the month, where we're looking to get views of 100 buy sides to get an idea of what are the key pain points everyone is seeing as part of the UMR delays. I will now hand back to Helen. Thank you.
Thanks, Chetan. Let's now take a moment to look at the market reactions. Asma, Liam, we've heard Chetan's thoughts. Do you believe the market is ready for phases 5 and 6? Asma, would you like to comment first, please?
Thanks, Helen. Hi, everyone. Well, as Chetan said, in the remaining phases 5 and 6, initial margin requirements will apply to a large number of entities for the first time. And despite the one-year extension, there is still a great deal of preparatory work required to ensure UMR readiness. And we should not underestimate the complexity involved and the level of advanced planning required. While phases 5 and 6 mainly capture buy-side firms, the sheer number also creates operational challenges for the sell side. On one hand, the contractual framework for meeting IM requirements is time-consuming and can take many months, as account control agreements between both parties' custodians need to be in place, as well as bilateral IM credit support agreements. It is suggested to start repapering negotiations with the dealers and setting up custodians' account at least 6 months prior to implementation date. On the other hand, IT and operation systems must be established and internal processes put in place or updated. For buy-side firms, the technological infrastructure that supports the posting and receiving of IM is both complex and costly to develop and maintain. As for operations, they will need to perform calculations of IM using SIMM or grid, along with management of margin calls and reconciliations. Due to all these challenges, most of phase 5 and 6 firms are not ready yet. There is a survey conducted by State Street last June covering 300 asset managers and asset allocators in 16 countries. And according to this survey, 86% of the firms already began preparing for phases 5 and 6. Among these 86%, only 19 say that they are well prepared, and the remaining 81% are not yet equipped to comply with all facets of the Uncleared Margin Rules. So as seen in these results, we can say that less than a year away from the next deadline, firms in the scopes of waves 5 and 6 remain primarily unprepared for the different aspects of the regulations. Some of these firms may think that they will stay beyond the threshold, but the regulatory guidance on this point states that covered entities will act diligently when their exposure approach the threshold to ensure that the relevant arrangements needed are in place if the threshold is exceeded. This means that the IT infrastructure needs to be fully in place before the IM requirement crosses the IM threshold. So firms need to think of the best model between outsourcing to service providers, subscribing to utilities, or keeping internally a certain control, dependent on their IT readiness and operational capacity. We have seen a demand for a hybrid model where firms outsource the IT infrastructure hosting and the technical monitoring of the application in a SaaS model while keeping operations and business monitoring within collateral departments. In summary, I would say there won't be a unique model applicable to all firms, but rather a fit-for-purpose setup that fulfills the objectives of each institution.
Thank you, Asma. Liam, would you like to add any comments?
Absolutely. So firstly, thanks Helen and team for setting this webinar up to date. So really just think about this a little bit more and following on from Asma's observations and the survey results there. What does ready actually mean? And I think this is really key, and it's one of the challenges that a lot of firms in both phase 5 and phase 6 have found once they start to look into UMR in a little bit more detail. What has tended to be the pattern for the buy-side firms in these phases is that initially they were aware of UMR and at a management level, they were told that there was this new regulatory requirement and they had to be compliant. And the first sort of response to that is to assume that it's an operational compliance model. And then when they start to look into it a little bit more and they start to understand the full impact of the regulations and the collateral impact of that on their firm, they start to realize that there are quite a lot more to it to really be truly ready. So you can think about readiness really in two parts, I think. On the slide here, the three items on the top row, the operational flow, these are the points that Asma was referring to. So it's really about actually making sure that you've got your operational steps, your systems and your processes in place so that you have the ability to actually exchange collateral two-way, that you have the potential, you have your operational paperwork and your custodians in place ready for if and when you are exceeding posting thresholds and have to start exchanging. And that critically that you have actually tested with your dealers, with your counterparties on an end-to-end basis well in advance of the in-scope target date, so that you have the chance to actually ensure that you've got your trade portfolios matched up and you've got your margin agreements lined up as well. So what assets are under grid, what assets are under SIMM, etc. We'll talk a little bit more about one or two of those aspects a little bit further on in the session today. But the other aspect of readiness, which is, as I mentioned, is critically important and more firms become aware of as they start to look at the problem, is what we might call analytics or optimization, or you might think about as the business impact of the regulation. And to be ready from that perspective is a slightly different challenge. So it really comes down to firstly looking at where do I sit in terms of the phases, phase 5 or phase 6. So what is my ANA threshold? And the first sort of step of any responsible firm is to see their proximity to that threshold and whether or not they are able to take business steps by making some changes to their portfolio to potentially remove themselves from that phase. If you're phase 5 and you can get yourself under the ANA threshold, you're really just delaying it by a year, but that has a material benefit, that has a cost benefit from a year less of that additional collateral requirement. And if you're in phase 6, then potentially you've got the opportunity to get yourself out of scope completely. Now, that's certainly not something for every firm or even most firms, but it's part of the readiness process. And then, assuming that you are then in scope and you have determined which phase you are going to be in scope for, you then have to apply a bunch of other processes. You have to ensure that you can actually set up, as well as setting up the operational process, that you can set up an active control process. The additional collateral requirement that comes with UMR can be very significant and can have a material business impact. So therefore, you need to look at how you can implement controls across your trade lifecycle. And that means looking at it in the front office as well as intraday active sort of monitoring of your agreements and your positions. That ties into actively monitoring your thresholds, and this is refers back to what Chetan mentioned as well. The posting threshold that you will negotiate and agree with your counterparties as part of the operational readiness, maybe $50 million, which is or equivalent in different currencies, which is the sort of maximum mandated by the regulations, but it could well be less. And you also have to be aware that that threshold is at a group relationship level, and therefore you need to understand and make sure that that is factored into your monitoring process. But then once you've understood and agreed that, you need to bring that threshold monitoring into your daily trading controls, so that at pre-trade time you can have that that factor being checked and potentially alerted as part of any trading decision, and ensure that you are not going to accidentally trade into a counterparty agreement that's going to breach that threshold and therefore trigger collateral flows which you could otherwise avoid. And the other part of this sort of analytics readiness stage is to also be looking at how, on a post in scope basis, you can optimize and reduce your actual initial margin exposure. So by that I mean, once you've understood which phase you're going to be in scope for, and you've looked at your ANA thresholds and optimizing or reducing those, you've figured out which phase you're now in, you can still go further and look at how you can reduce the actual initial margin exposure itself. And there are various steps there which you can take, which might involve primarily the most obvious way to do that is to migrate some of your exposure from bilateral trades into clear trades. And we've seen a lot of clients, a lot of firms put a strategy in place to do this, particularly in the FX and in the rates worlds. There can be quite a lot of opportunities to take some of your, or potentially even all of your bilateral exposure down below your thresholds. You may also, when you actually do the analytics and look at both the collateral and the carry cost of that collateral, you may determine that it is actually preferable just to unwind and remove some trades. Potentially, you know, if they are hedging trades, for example, you may decide to rebalance the book or hedge the risk with different contracts, or just remove some of that hedge. And you can also look at compressing your exposure. Firms will often find that you have exposure that's built up over time across multiple counterparties that hasn't really necessarily been reviewed or been actively managed, and that can be compressed on a holistic firm-wide basis. We talk about this really as unilateral compression, or using novation or straight line item compression techniques. So it's a different thing to the sort of bilateral or CCP compression. But these are the analytic techniques that you can use to then make sure that you are, wherever possible, below a posting threshold, so that you don't have to post margin at all, and that you are controlling and aware of the potential impact of any trading activity on your margin and collateral requirements. So just circling that back to the question, how are firms at this point in time in terms of readiness? So our direct experience, sort of talking and working with the market, working with phase 4 and phase 5 and phase 6 firms, is that phase 5 is a bit of a mixed bag. At the start of this year, when phase 5 was still expected to be this September just gone, there was a reasonable portion of the in-scope firms had actually got underway with their projects, which included both the operational readiness and the analytics readiness. So they were putting their analytics tools in place. They were starting to work with their counterparties and build up to the reconciliations and the tie-ups. Those firms have continued those readiness projects despite the delay, and we've got a bunch of clients, and there are various other firms in this position who are in a very good place. They're in good shape and they're ready. Acadiasoft has been running its Project Blazer, soft go live reconciliation processes with dealers. So there's a number of firms that are well positioned, but equally there's the other part of the market who were not really who had not really kicked off their projects at the start of the year, and then when the delay was announced, they have taken the opportunity of that to take a bit more time over their preparation. So they are still in reasonably early stages, and we are expecting a lot of those firms to really put their full project teams in place for the new year and start actively engaging across the board. And the phase 6 firms, really, I mean, that's a broader market. A lot of those firms are going to be below the thresholds, or expect to be below the thresholds, and are really at this point playing a bit of a wait and see game. We do have some clients who are phase 6 firms who have engaged very early, ready for a sort of project to kick off in 2022. But in general, in that market, I would say that we're not really expecting most of those firms to get actively engaged until mid next year.
Thank you, Liam. Perhaps we could now have polling question 2. Audience, you should see the polling question on screen. So if you could take this opportunity to make your selection, that would be appreciated. Just give this a few seconds. Okay, I think currently we have approximately 15 people who have made a selection. There are a number of you still to make that selection if you could. The question for those of you who may or may not be able to see it is, what stage of project implementation are you at for UMR and SIMM? A, researching the situation, B, creating an implementation plan and estimating a budget, C, implementation complete and budget allocated, D, implementation in progress, E, complete, or F, don't know. Okay, could you share the results of that, please? Yeah, there we go. We've still got quite a few who haven't, but perhaps now we could hear a little from the vendor perspective about what has been done to address the issues. Liam, would you like to start on this? I am conscious of time, so I think we'll probably have to speed through one or two of these sessions.
Sure. Yeah. I mean, I think when we talk about solutions, it's fairly straightforward. I mean, on my last slide, we were describing some of the challenges firms have to solve for there. The one comment I would add is that bear in mind the market that we've been in this year. We've been in the COVID market and the kind of incredible volatility that we saw as a result of that in the first part of this year. And that presented presented its own challenges to particularly the buy side. And when you look at how you solve for those challenges, they really overlap and are very, very similar to how you solve for the impact of UMR. Because essentially it all comes down to collateral liquidity. What is the additional collateral requirement imposed on the firm as a result of either regulations or of market volatility? And that then comes back to how do you manage and control that, and how do you manage and control the upstream margin that's generating that collateral requirement? So from the Cassini perspective, our sort of role that we see is to provide those analytics tools for firms in this space. And really around the analytics and the controls themselves, that means providing a set of tools that provide transparency. So you can't really do anything to control and reduce your margin and collateral exposure if you don't know what's driving it. So having transparency and drill down into your portfolio is the first step. Then providing those controls and those tools that I talked about across the trade life cycle. So that means pre-trade margin and collateral checks. That means forecasting tools to be able to project forward and test what ifs or sort of trend analysis, and intraday monitoring, and both for collateral liquidity and threshold monitoring. So those are really the kind of set of tools, and that's what Cassini is all about. I'm not going to go through all of the boxes on the right hand side in our sort of solution set, but that's really where we're helping firms. And particularly when we look at UMR margining itself is obviously SIMM and grid, and you need to be able to support both. So Cassini provides the whole calculation platform for that, from sensitivity generation across all the very, very broadest set of asset coverage that you will see in the OTC world. The actual generation of the SIMM results itself, applying the grid model where that is applicable to subsets of trade or asset types. These counterparty agreements can have both SIMM and grid under the same agreement, obviously depending on which asset types are agreed with your counterparty. And obviously a part of that process is generating the CRIF, which is essentially the underlying sensitivity data that you need to then work through and pass through to the reconciliation process, so that you ensure that you have a full top to bottom reconciliation with your counterparties. So this is really Cassini's piece of the jigsaw, and I think I'll pass that back across to Asma to speak to the kind of collateral workflow piece.
Okay, perhaps this is a good time to announce the new partnership between Cassini and VERMEG. VERMEG have been approached by several organisations over recent months looking for a lightweight hosted solution with sensitivity provision and calculations, plus the connectivity to external platforms. Asma, would you like to elaborate on this?
Yes, sure. So to support the industry in this transition, at VERMEG, we adapted our solutions to the different models. We propose a SaaS offer, Colleen.cloud, that has different levels of services covering the whole value chain, from a simple monitoring to exchange and SIMM, reconciling, and optimizing collateral management across cleared and uncleared businesses. So the lowest service in the value chain would be a model in a joint effort with Cassini, where we receive from them the IM value, we monitor the IM threshold per agreement and at the group level, and we alert in case of a breach. If the threshold is breached and IM needs to be posted, We cover the whole margining workflow, including the agreement setup and the eligibility schedule in a fully STP'd process. And of course, in case the firm has to post a form of house IA, we support the different margin approaches, distinct, allocated, and greater of approaches. So moving forward, to meet both IM segregation models, our tri-party and third-party services, or a combination of both, will allow both pledger and secured parties to seamlessly and more efficiently deliver collateral to meet their Reg IM obligations. In case of IM differences, our reconciliation module allows to easily reconcile, identify issues, and resolve disputes. So all this has been done to help firms comply with the regulations with efficient costs. But for firms who would like to have a more strategical view of their collateral management, we provide a suite of services to cover other business lines like cleared OTC derivatives, repos, SBL, and ETD. And we provide an optimizer to reduce the cost of collateral funding and optimize the overall inventory utilization.
Okay, thank you, Asma. We're now going to move, in the interest of time, to the panel session, just so that we can make sure everybody has an opportunity to update from the market perspective. And the first question I have is, what strategies are organisations utilising to avoid phase 5 and 6? We have covered some of this, so I'm going to ask you to keep your answers brief, but I'd like to start with Chetan.
Sure. So IM portfolio scenario analysis. So this is where you look at the trading history with your relationships and you simulate the IM numbers under SIMM grid. This allows you to work out where you apply the part of the 50 million threshold. So you might have some entities or relationships that aren't operationally ready. You can allocate a large part of that threshold to them to allow them to avoid phases 5 and 6 in totality. Another one is around IM optimization, where you're looking at trades that are not mandated to be in the IM calculations and including them because they provide a risk offset. So example of this is we've seen clients who negotiate now physically settled FX forwards and swaps, which are excluded from IM rules, but you can include them to get a positive impact on your IM. And also looking at exchange traded derivatives and having the capability to go into ETD is also another lever clients can use.
Okay, Liam?
Yeah, I mean, I would agree with all of the things that Chetan just enunciated there. In the interest of time, probably not much point repeating. I mean, I think essentially the overall view is looking at where you can potentially express or move risk in your portfolio to take full advantage of either clearing margin levels, which will be generally lower than your UMR will, or to maximize the portfolio offsets.
Asma, have you got anything to add?
Yes, so at VERMEG, we can help with a SIMM monitoring service with the SaaS deployment and with the centralization of both cleared and uncleared OTC derivatives to achieve a close and common monitoring of the collateral assets. And for firms moving to clearing, our clearing module provides connectivity to the market-leading CCPs. Our new Colin.Cloud SaaS offer removes the need for organizations to support burdensome internal infrastructures and can speed time to market with rapid onboarding.
Yeah, thank you. Now, maybe some time for some sharing of war stories. You've all assisted clients through the first 4 phases. Is there any advice or experiences you'd like to share with the audience today? Chetan?
Yeah, sure, quite a few. So let me reduce it down to the key ones. The key one for me is around eligible collateral schedules. This is where you spend a lot of time going back and forth with your counterparties and also your custodians, and depending on if you're going to go with a tri-party model or a third-party custodian model. So it's really important to plan and have a policy around eligible collateral schedules. And one thing to remember is cash is not king in initial margin UMR world, and you need to understand what are the options you have on the table. Would you look at money market funds? Would you look at equities? So clients are now looking at broadening the eligible collateral schedules when we go into phases 5 and 6. Another point is around start the onboarding process and testing with custodians, because the custodians all have different KYC, AML onboarding processes. So it's really important to understand the custodians. And Atma mentioned a point earlier in the webinar where you're going to lose time. When we look at some of the custodians, for example, Boney, they're looking to receive their ACCA agreements by March the 31st. So now you've lost 6 months in your project plan around that space. So really understand the timelines for custodians and have a plan for your eligible collateral schedules. That's my advice.
Thanks, Chetan. Asma, obviously we've assisted some clients through the first 4 phases. Would you like to provide any insight?
Yeah, well, if there's a lesson to learn is to streamline the process from receiving RQV to the final settlement of the margin requirements, and more importantly, have an STP process covering additional checks like the concentration limit breaches and the eligibility of the assets. And if I would advise firms, it would be to use the delay to ensure that they have the appropriate operational processes in place with sufficient controls to ensure their regulatory compliance.
Liam?
Yeah, I'd say pretty similar to both of those really, but the other sort of spoke of the wheel. So what we've seen particularly is clients who have left it, have not started early enough in their preparations, and particularly as Chet was talking about engaging with the custodians. I think it's also key, or we've seen it be a problem for firms that haven't engaged with their dealer counterparties early enough. Again, with this whole process, as well as all the operational side, you've got to make sure that your models and your calculations and your sort of sensitivity and margins are actually going to tie up and be agreed. And you can have wrinkles in that based on your sort of your collateral agreement terms, but also just the actual calculation models and market data. So get involved, speak to your dealers as early as possible, and start working with them to ensure that you've got clarity on terms and that your trade portfolio is actually fully reconciled with them, and that you've got no discrepancies in terms of trade economics or T's and C's.
That makes sense. Okay, now maybe a topical one, but given the pandemic and the effect on the market, what do you believe organisations should now be looking for, particularly in the coming year? My
answer to that really, and again, what we've seen this year would be that the pandemic has various impacts on firms. It has just logistical problems, people having to work from home, etc. But the biggest business impact is the volatility. So as I mentioned in one of the slides earlier, it's kind of similar challenge to managing UMR anyway, which is that to manage volatile markets and ensure that you have collateral liquidity and that you're not getting closed out of positions to meet collateral calls, you need to have the trading controls in your front and middle office and actively managing that environment and looking for where you can offset and compress trades to reduce margin requirements.
Okay, Asma?
Yeah, so the COVID pandemic galvanized people to innovate their way out of problems and reinvent new models for a new state. So while containing the short-term disruption is the priority, collateral departments still need to prepare for the future by transforming their operating model to be cost-effective, more flexible, regulatorily compliant, and built to be scalable and resilient. Thus, a strategic and more holistic review needs to take place now, where firms need to pick up the right partner.
Okay, and Liam?
Well, Chetan, I can take this one. So, yeah, that's all right. Like the guys have said, that the pandemic has proven we can all work remotely and manage from distance. So our advice would be to outsource as much as you can, but keep the key decisions under your control. Look into web-based applications. Look at having the kind of clear roles and responsibilities. And with the next year, with more regulations coming into play, it's just having a more broader strategy around collateral, not just for IM, but also looking at VM, repo, sec lending, and bringing it all together with all the web-based technology that's available now.
Great, thank you very much. I'd like to thank all the panelists. I think that's been very useful. I'm now going to ask ISDA's Amy Caruso to share her thoughts. Welcome, Amy.
Thank you, Helen, and thank you all for joining the conference, but especially thank you for having ISDA join on as a special guest. So I appreciate it.
Okay, Amy, UMR will require more margin calls to be sent, restrictions of eligible collateral and condensed timeframes for collateral settlement. What has ISDA and its members been working on this past year to help the industry drive operational efficiencies?
Well, I'm probably going to repeat a few themes that Chetan and Liam and Esma had referenced. But after some surveys and member outreach in 2019, we prioritized 4 topics for operational efficiencies in the collateral management process. And while they're very much influenced by UMR, they can, as Chetan had just referred to, really be extended to variation margin and other types of collateralized products. So we just released our 4th of 4 user guides. They're called the Collateral Management Transformation Toolkit. And if we can move to the next slide, I'll highlight the 4 topics. So the first is custodial onboarding for segregated accounts. As all of the panelists had mentioned, it's important to have a coordinated process, and in this document you'll find those. Digitizing documentation and streamlining that data to your collateral management operating systems, portfolio reconciliation and dispute resolution, and last but not least, automating collateral settlement and reporting. So these documents, which you can find on ISDA.org in the margin section, are set up to provide sample use cases and sample implementation plans. Also, we have interactive cost-benefit analysis tools in these documents, so you can assess your current situation and also project what an investment in additional improvements will result in, say, 1, 3, and 5 years out.
Okay, thanks, Amy. So one of the UMR requirements that is new to many industry participants is for segregated collateral. And the panel discussed briefly the structure of the segregated accounts earlier, including both tri-party and third-party. What can industry participants do to ensure that they are efficient with custodian onboarding and also margin call and collateral settlement that's unique to these segregated accounts versus the non-segregated accounts?
So first of all, with segregated accounts, you really need to have both the pledgor and the secured party involved in the onboarding process. And using the Collateral Management Transformation Toolkit, there are steps that you can go through. We also, through our ISDA Margin Info Hub, have a tri-party and third-party UMR implementation checklist, which we developed with SIFMA AMG. And that really goes through all of the KYC, the compliance, and to Asma's recent statement, really the expediting the settlement process. Now, segregated accounts are a little bit different than, say, your traditional VM account, because I can't just pledge assets to Helen. Not that I think she's going to go off and buy a new car. Maybe, but I have to segregate that collateral into an account on her behalf. And then if I want to get that collateral back in our account control agreement, there is a statement or instructions that she has to give permission. Sometimes it can be both parties, sometimes it can be just one, but it's the authorization of release that is key. And in today's environment, using faxes, which is predominantly used when we're all working from home, is not efficient. So we really want folks to use the tools and the information on the ISDA Margin Info Hub to release that collateral in an automated fashion.
Okay. Now, sometimes regulatory requirements are met with a knee-jerk, let's just get it done reaction. Yep. With the delay from the regulators, how, in your opinion, do you think entities and firms that are in scope can use the extra time to their benefit? Now, we've heard different bits and pieces from the panelists today, but it's just interesting to get the ISDA perspective on, what really they should be trying to do.
Thank you. So, well, I think we can all agree we would much rather have had to put things in place for September 2020 and 21 rather than being in this situation with a global pandemic. We also can realize sometimes we need to make the best of what we have, and we do have additional time. That additional time should not only be used on how to figure out to get documents signed when we're working from home, but really to look at operational efficiencies and how we can be much more efficient from onboarding custodians and counterparties, amending documents in a digital fashion if possible, streamlining that digital data into operating systems to reduce the onboarding time and operational risk associated with that. Setting up a portfolio reconciliation and dispute resolution program, maybe specific to initial margin, but considering your infrastructure that you already have in place for variation margin. And last but not least, the collateral settlement. So to reiterate that we really need to reduce the time to settlement, and then also with confirmation of settlement, you can be much more efficient with collateral optimization, which I know Liam is a big fan of.
Yeah. Thank you. So the next one, obviously, Amy, I'm going to put to you, but I'm actually also going to ask the panelists to chip in at the end on some of their thoughts as well. So we've mentioned before that eligible collateral is prescribed by the regulatory bodies and then further negotiated between the counterparties. Now, managing this collateral through the negotiation process and then the processing business as usual piece can be complicated by a lack of standardisation. What are some of the developments at ISDA and in the industry in general on this common challenge? Amy, obviously, I'll put this to you first and then open it up.
Thank you. And if we can move up a few slides, I think it's the last ISDA slide, we have some information. Next one, and then the next one. There we go. So, oh, a little too far. Very good. So my colleague Vernon Alden-Smith has really been leading this with a great deal of input from working group members, including VERMEG and others, to help digitize the elements of eligible collateral so that this information can then be more easily negotiated through online tools like ISDA Create and eligible collateral schedules. And then also, again, streamlining into operating systems. So whether, as Chetan had mentioned, tri-party providers who are managing your collateral efficiency, or an outsourced administrator, or if you're doing it in-house, having those data elements in a digitized fashion can really reduce some of the operational risk, which then ties to better liquidity management. So you'll see here a number of criteria and elements that we've already deployed in the common domain model, and this is available in a number of different programming languages that you can consume into your systems.
Okay, thanks. Asma, would you like to comment on Amy's information?
Yes, so yeah, I totally agree with Amy when she says that it's crucial to have operational efficiency. Streamlining the whole process to deal with the increase in volumes and reduce the cost of operating collateral management is very important, and I guess it's one of must-haves that a collateral management system should have.
Chetan, would you like to add anything?
Yeah, sure. You know, if we look at the history, that is the product taxonomy has helped so many organizations with the exposure upstream. Now it makes more sense to look at the collateral and have a common domain model, because there's so much time wasted between organizations around the eligibility of collateral, and having standardization is really important when we look at the volume of eligible collateral schedules and agreements. So strongly behind this initiative.
How about you, Liam?
Yeah, likewise, big fan. I think it's well overdue in the industry for this kind of consistent way of defining and looking at these things. It obviously requires that you have reference data which sort of maps in order to ensure that you then have the eligibility and you can optimize fully. But this is a key kind of a consistency tool which is going to be very valuable.
Great, thank you. So I'd like to thank you all for participating today. But before we close, we do have a few minutes for one or two audience questions that have come in. We may not be able to get to all of them today, but if we don't, then we will do a follow-up and can certainly respond on email, providing we have the email addresses. So how are the firms planning to fulfill the exchange of initial margin? Maybe Chetan, you can share some of your consultancy experience there.
Yeah, sure. So as I mentioned earlier, firms are now looking at non-cash collateral. So we've seen a number of organisations looking into including equities and also money market funds. So the money market funds are a hot topic in the industry, and depending on your regulatory jurisdiction, certain of those funds are allowable. So it's looking at broadening the eligible collateral. So it's not just necessarily your kind of government debt; it's also looking at money market funds and equities. Is what we're seeing.
Okay, Liam?
Sorry, Helen, can you just, I didn't quite catch the question.
Sure.
The audio went.
How are firms planning to fulfil the exchange of the initial margin?
Well, I wouldn't really add too much to that in terms of what Chetan said in terms of the asset types people are using. It's very much, it varies a lot from firm to firm depending on what's actually available in their inventory, and that's it is one of the key things, which is why minimizing that collateral exposure is key, but also then having strong collateral optimization available so that you can use a range of assets to meet this requirement and not be stuck always trying to post cash or whatever it might be. So optimization is the key.
Okay, Liam, this one has actually specifically been targeted at you. So how, in your opinion, should a firm organise themselves to monitor and manage their approach to the 50 million threshold?
Right, yeah, I mean, I think this is ties a little bit into what we were saying earlier. I think the key is to ensure that you have the transparency on what the thresholds are across all of your potential counterparty agreements, and that you have visibility on that in your front office process, so that you are doing two things. One is that you have a daily transparency through some kind of tracking or report or dashboard over where you're sitting in terms of those thresholds, but equally or more importantly, that before you execute any trades, you can determine the impact and the potential risk of those trades breaching the threshold. So it's transparency and pre-trade checks are the key.
Okay, thank you. Now, we have one that's just come in from the audience that I'm going to put to both Chetan and Asma. The question is, what do you believe is the most important feature of a collateral management system right now? Asma, would you like to go first, or Chetan?
Sure. So it's a great question, and for me, the key attributes for a collateral management system is to have full STP capability. So there is ways to kind of automate the workflow with the volume that's coming in. You can set certain rules and have a web-based application. So having a fully automated workflow that can run from left to right, and it's more you're moving your organization to exception management as opposed to just clicking buttons.
Asma, if you're now off mute, would you like to?
Yes, sorry, I was on mute. So.
It's okay.
So I think there are a couple important features. First of all would be the regulatory compliance in terms of implementing all the regulation requirements. Second, and as I was saying, the operational efficiency and streamlining the whole process. And last but not least, connectivity to upstream and downstream systems to ensure front to back processing.
Okay, I think we've got time for one quick question, and then I'm going to ask all of you to just give one final throwaway comment to the audience. But the next question I'm going to put to Amy and to Chetan. What are the minimum governance steps that firms need to have in place, just at a very high level? Amy?
Sure. Minimum, I guess, is a relevant term, but I think the most important aspect of that is to first ensure that you're monitoring your 50 million threshold and also working very carefully with your end client. So if you're an asset manager and you have separately managed accounts, then you need to make sure that you're organizing your documentation and your monitoring with that in mind.
Thanks, Amy.
Yeah, I would add, you need to have at a minimum an IM model governance policy and procedure document. So this is where you articulate who is your first line defense, second line defense, and third line defense. The regulators are very keen to make sure that you understand how the model works. They appreciate that you can outsource this model, but Does the model work for your portfolios? What are the internal controls around the model? Who approves the model? Who validates the model? And who makes sure that the model is audited? So having that model governance is really important, and it's a minimum from a regulatory point of view.
Great. So we are just about out of time, but I'm going to ask you all for one final throwaway comment. So Liam, would you like to start?
Yeah, one throwaway comment is the most important thing. Understand that margin, and more importantly, the collateral required for margin, is a key business cost, impact, and risk, and make sure that you have sight and control over it from front to back.
Thank you. Asma?
Yes, so as a final takeaway, I would say that firms that are in the scope of waves 5 and 6 should take advantage of the additional time to implement strategic rather than short-term solutions. They should not only effectively manage but optimize their collateral management with the right solutions and technology in place.
Thank you. Amy?
I welcome everyone to go to ISDA.org and the margin page and see all the resources that are available, whether you're an ISDA member or not, so you can be well prepared, assess which entities are in scope, put together a project plan for your initial margin calculation, custodial onboarding, and then also your operational aspects such as portfolio reconciliation and dispute resolution. So good luck to everyone as they look forward to the next 11 months, 10 and a half now.
And finally, Chetan?
Sure. Yeah, since 2013, we've been successfully delivering UMR compliance projects across phases 1 to 5, and it's clear to us there is not one size fits all solution. We strongly believe that the delivery of a successful project is linked to utilizing the collaborative UMR ecosystem and making extensive usage of technology that is available. There are many options to help you achieve compliance and at the same time consider the wider collateral strategy for your organization. Working with consultants like us who have deep experience in delivering collateral capabilities to firms in all shapes and sizes and buy side will accelerate your projects and increase your success rates. And I wish you all good luck in your projects, and hopefully SIMM is back on your radar.
So I'd like finally just to thank all the speakers today and the audience for their participation, and good luck everybody, as everybody says on the panel, and hopefully we'll see you the other side of September 2021. Thank you.